Hello, class. Welcome to this video. This is a chapter 5 video. We're going to be getting into talking about accounts receivable today. Apparently somebody's messed around with my stuff and they switched my camera around. So, and this is on camera. It's here on top of my screen. I'm going to put it down here on me like so. All right, so I decided for the chapter 5 video, I'm going to break it down into 2 videos. And hopefully to make it a little bit shorter, but what we're going to talk about here, we're going to talk about accounts receivable. So when we make sales, we've talked a lot about the revenue recognition principle, that we have to record those sales at the time that the goods are delivered or the services are performed. So hopefully that's sticking in your mind. But now we're going to talk more about the amount of sales that come in, and receivables when we collect our receivables and things of that nature. I'm just getting some stuff moved around on my computer here. Let me bring up so I can bring up my PowerPoint and get my screen shared with you, and we can get started on this lecture. All right, so chapter 5, we're going to be talking about sales and receivables. What we're going to do is we're going to talk about the revenue recognition principle quickly again. We're going to talk about sales revenue, because sometimes there's things that come in like sales discounts, sales returns and allowances. And then we're going to talk about receivables as a whole, because there is more than just accounts receivable. There are notes receivable, a few other things. And then we're going to learn how to record bad debt expense. One of the things about receivables is you can never assume that 100% of the people are going to pay you. Whatever you sell on credit, there's always a risk that some people are going to pay. In order to meet this matching principle, we need to record the people that aren't going to pay as an expense in the period in which we expect it to occur. So we're going to take some estimating that comes into play here. Okay. And then we're talking about notes receivable a little bit more, and we're not going to get real deep into the internal control procedures. Okay, remember that we are doing accrual basis accounting, so that we have to recognize the revenue when the company's performance obligation is satisfied. In other words, when the goods are delivered or the services performed. Okay. The appropriate amount of revenue to recognize is generally the cash received or the cash equivalent of the receivable. When it says cash equivalent, it means what you're expecting to receive. Okay, because we can get discounts, returns, and allowances. All these things are going to affect our revenue amount. Okay, when we go to recognize our revenue, which is recorded as a credit on our journal entries. Sales discounts are offered for prompt payment. Okay, there's a lot of business to business transactions. Okay. If I'm manufacturing food and I need corn meal and I'm buying it from the mill is going to give me some kind of credit terms to encourage me to pay them quickly, more than likely. Okay. The discount reads like this down here. Whoops. I was hoping I'd be able to highlight it. Okay, but down here where it says sales invoice using the standard notation with discount credit terms, at the very end of the third little bullet point down here, it says the notation would be 2-10 net 30. Okay, the N stands for net. That means you're going to receive a 2% discount if you pay your bill within 10 days. If not, the remainder, the net, is due in 30 days. Okay, and then usually after that discount period, then there's going to be some kind of interest charged or late fees assessed for not making that payment. Okay, that is called the gross amount. Okay, before any kind of discounts are taken out is determined to be the gross amount. With the discount taken out, that is known as the net amount. Okay, so there's 2 methods to record this. when we go to record revenue for our sales discounts, there's either at the gross amount, that is before discount, or the net amount after discount. It's mostly based on your customer base and what you expect. But now 2%, 3% discounts that we're going to see are advantageous for most businesses, and they're going to pay within that discount period. So the most common way to record this is at the net amount. So that's all we're going to focus on in this class, is recording sales at the net invoice amount. So that is what they actually expect to receive with the discount being taken. And here's kind of the reason why here. You go through this slide, it'll kind of show you why companies are going to pay that 2% discount when it adds up to a 36.5 annual interest expense savings. So, okay, so on May 5th, GCD Advisors billed Richardson Wholesale Hardware $15,000 for consulting services provided during April. Okay, so we're sending out a bill here. The service has been provided, so we get to recognize revenue. Okay, happened on May 5th. When we sent this out, we offered terms 2, 10, and 30. So then we're going to give them a 2% discount if it's paid within 10 days. If it is not, the remainder is due within 30 days for $15,000. So prepare entry using the net method. Using the net method, we assume that they're going to pay. So the first thing we have to do is calculate how much are they going to pay. Okay. Here it has 14,700. Okay, that is the amount we expect to receive. They got that here. It tells you by taking 15,000 times 98%. That is because we are giving a 2% discount when we send out the bill on May 5th. Okay, we assume that they are going to pay within 10 days. So we are only going to receive 98% of that bill. Okay, so you take the billing amount of 15,000 multiplied by 98%, and that is the amount you record as sales revenue, and that is the amount that you put into the receivable. Now, if they pay on time, so May 15th, 10 days, they are within that discount period. So we just record the cash as a debit, and we increase our cash when the payment comes up, and we take it out of accounts receivable. We make that account go down with a credit entry because they no longer owe us any money. Okay, so that could happen. Or 3, these both can't happen. 3 is when they pay late. Okay, so if they were to pay late, they would not get any discount, so they would be paying the whole cash amount of $1,500. We only recorded 14,700 up here at the top as an accounts receivable, so we can remove that all because they do not owe us that anymore with a credit entry. But at this point, we have to record the remaining sales revenue. Okay, the difference here, the $300 that we didn't expect was going to be revenue because we expected them to take the discount. Well, now they didn't take the discount, so we need to update our revenue here with the remainder. All right, so here's a knowledge check question for you, trying to work this out. Yeah, so down there, hopefully you figured out that it is B. You debit your accounts receivable by 9,800 and you credit your sales, just what we did there before. Okay, we sent them a bill, $10,000, the services were provided. Okay, so we get our revenue, which they're calling credit sales here. Okay. So services provided, so it really could be service revenue. But anyway, this is our revenue account. Okay. We only expect to get $9,800 because we were giving them a 2% discount of the 10,000, which is $200 discount if they pay. Okay, so we would only expect to collect $9,800. That's all we record as revenue. Also, we have sales returns and allowances. Okay, Sales returns are when goods are unsatisfactory. As a business owner, okay, or just if you're the manager or something, whenever you get a delivery of something, you have a right to inspection. That is law. So you're going to want to go out and inspect everything and make sure that it is satisfactory. You don't want to accept a product that's damaged and broken that you can't turn around and resell. Okay. So you then, when that gets done, then you pick up the phone, you call the company. Okay. You say this was damaged, this was damaged, this was damaged. They usually write you a slip here for a sales return. Okay. It's gonna happen. Stuff is damaged during transit, stuff is ordered, shipped wrong. Sometimes you ordered wrong, you think you ordered something, but you punched in the wrong number and ordered something else. Okay, there's many reasons why you would have a sales return. Okay, so companies need to account for this when they're taking the amount that they expect to collect. Okay, so at the end of a period, we are going to need to go in and estimate the amount that we expected to be returned and take that out of our revenue immediately for being conservative and trying to not overstate our income or our assets. Okay, at the end of the year, we have an account receivable balance of $1 million. Based on past experience, they say 0.2% of this balance is going to be returned. Okay, so this is kind of an arbitrary number here. It is not just made up, but it is based on past experience. The thing here, when it comes to accounting, there is a lot of professional judgment that comes in, which is what makes ethics so important in the accounting world. Okay, because you're trying to give the most accurate representation you can, so you want to make sure that this number is a good number. Okay, so the following January 18th, we granted an allowance of $1,500 to Mental Enterprises as a result of the late shipment. Okay, so first it says calculate the amount of sales allowances GCD will be made in the following year. Okay, well, they have credit sales of 1 million. They expect 2%, so times 0.002. We get $2,000 here. Okay, of stuff that we do not expect to collect. Okay, because we are going to give some kind of an allowance back to the customer. So when we make an adjusting entry here, when we estimate this, we are going to debit our sales revenue. Debit makes revenue accounts go down. So it lowers that. We are going to create a liability here, returns and allowances liability. Because we know we're going to have to give some of this money back from our sales to somebody, we just don't know to who yet. So we owe it out here, so we're going to create a liability for that. Okay, that is all estimated amounts. Then when it actually happens, okay, we actually go to make an allowance to a customer. The customer calls up and here, I think it said it was a late shipment, so they wanted some kind of discount. So then we estimated 2,000 at the beginning of the year. We already taken it out of revenue. We don't need to take it out of revenue again. We just lower our liability. Okay, we lower it by 1,500, and we take it out of accounts receivable because we are not going to collect that from the customer. So when it actually happens, as you can see, revenue is not affected here. Okay, revenue gets changed by the adjustments. We create a liability, and then when it actually happens, we lower the liability by taking it out of receivables because we're not actually going to receive the money anymore. Now we know that for a fact. Okay, so that was kind of how to record receivables with the discounts and the allowances. Okay, moving on now, we're going to talk about different types of receivables. We have what we've been talking about, our accounts receivable. Okay, the difference between an accounts receivable and a notes receivable is a note is formally signed, usually some kind of interest component. It's when you're borrowing money. Accounts receivable, you're usually receiving supplies, receiving goods. You're not actually receiving cash and paying it back most of the time with the accounts. Or I mean, you're not actually giving out cash and expecting it to come back with an accounts receivable unless you're in some kind of lending business. Okay, so notes receivable you might make when you sell something that has big monthly payments, interest component, stuff like that. There's current and non-current receivables, and that is comes in when they come due. Okay, anything that we expect to collect within a year is a current asset, so it is a current receivable. Stuff that we expect to collect after a year, that is a non-current receivable. It would be a long-term investment. Okay. This would be something we expect to collect on. So if we were a car dealership and we sold a car and we decided to take payments for 5 years, well, the first year of those payments, we'd have to put on our balance sheet as a current receivable, something we expect to collect this year. But the remainder of it will be a long-term investment that we expect to collect over time. But all of the revenue would go into the period that it was sold. And finally, there's trade and non-trade receivables. Trade receivables are what happens in the ordinary course of business, while non-trade receivables come when you actually maybe there are cash. Like I said, accounts receivable are not really, you're not giving out cash unless that's your line of business. Most of the time it's for inventory, supplies, stuff like that. So those are trade receivables. Non-trade receivables, maybe you gave an advance to an employee. Okay. So you would have an account called advance to employees, but that's really like a receivable because the employee is going to pay you back, or you can call it due from employees. Something like that. It's not your ordinary course of business. But maybe you do it, you give out your paychecks, maybe sometimes a couple days early if your employees are in a crunch. And then when the payday comes, you just take it back out and close out that receivable. So which of these would be a non-trade receivable? D, because it was a credit term to a customer. Non-trade receivables are outside the standard line of business, while trade receivables, trade receivables are for normal business operations. So a note receivable is a trade receivable. All right. So the next thing we're going to get into here is bad debts. Bad debts, I kind of explained a little bit in the opening. This is when we got to account for people who are not going to pay us. We cannot be naive and assume that 100% of our customers are going to pay. Okay, in a perfect world, that would be great, wouldn't it, if everybody paid all their debts. But we know some people will not. So in order to meet that matching principle where the revenues and expenses have to be matched up in the same period, okay, we need to record bad debt expense. Okay, we need to do an allowance method. I'm going to show you 2 different methods of direct write-off and the allowance. Okay, but the direct write-off, you do not actually record the expense for them not paying until you're 100% certain that they're not going to pay. And that violates that matching principle I was telling you. It can therefore, this method can only be used if bad debts are immaterial. Remember materiality, that's the thing that's the concept that says whenever it can be omitted if it would not affect the user's decision. So what this is meaning is that this method can only be used if bad debts are a really, really minor part of your business. If you don't have much bad debt, if 99% of your customers always pay, you can do the direct write-off method and just record the bad debt expense when it happens. But if you're like most businesses and, 90% of your people are only going to pay, and you know that for a fact, you're not going to be able to use the direct write-off method because that would be a material amount. So instead, you're going to have to use an allowance method. Okay, this is going to create a new account for us. Okay, so we're going to have to record bad debt expense by estimating how much we expect that people are not going to pay. Expenses under the dealer formula there, expenses are a normal debit balance. Okay, so we're going to have to make a credit entry in order to balance that out. And what we're going to make there is another one of these contra accounts. And contra accounts are, if you remember, from one of those is like accumulated depreciation. It's linked to the property, plant, and equipment, lowering its value. Well, in this case, our contra account is going to be the allowance for doubtful accounts. Okay, when I get through helping you with the homework, I'm going to write that as ADA. Allowance for doubtful accounts. It's always linked with bad debt expense. Okay, and it is a contra account to accounts receivable. It lowers the amounts of receivables that we are going to present on our balance sheet. Okay, so anytime we go to estimate, our very first entry is going to be a debit to bad debt expense and a credit to this ADA account. Okay, and then hopefully looking forward, if you can guess, when people actually do not pay, and we find out that it's known, then we just lower the ADA with a debit, and we actually credit our receivables now and take it out of the account that we actually know that is not coming in. Okay, there's gonna be two methods in order to estimate our bad debt expense and what we put into our allowance for doubtful accounts. There's a percentage of credit sales method and the aging method. We're gonna get through the percentage of credit sales method in this lecture, and then in lecture 2, I'm going to cover the aging method. So here we have an accounts receivable balance of $1 million. Although no customers have defaulted, we estimate that 25,000 of the balance is uncollectible at the end of the first year. What adjusting entry would we make? Okay, this gives us the amount. Okay, this just straight up gives us, we estimate $25,000 with this $1 million we're not going to collect. So there's no calculations. Remember what I just said a few minutes ago, anytime we record, make our initial entry, it is to bad debt expense. When we estimate how much we cannot collect, we are expensing it in the same period that we have the revenues come in. We do a debit to bad debt expense and credit the allowance for doubtful accounts. Okay, you don't need to worry about 2 so much, but that's just showing. Oh, so that's showing how it's linked to the accounts receivable here. This is how it would be reported on our balance sheet. Accounts receivable under the current assets. Let's say accounts receivable 1 million, less allowance for doubtful accounts 25,000, meaning our accounts receivable balance that they're going to see is 975, because that is what we are expecting to collect. So let's talk about getting that bad debt expense number. First is the percentage of credit sales method. This is based on past experience. If you're a retail store and you notice, or even a service provider, you notice that it's about 3%. It seems like every month, we don't know, but about 3%, or people aren't paying every month. That may be the way you want to go about estimating what your bad debt is. Okay, so this is a simple method. What you're going to do is you're going to take how much credit sales or credit services you perform during the period. You're going to multiply it by the percent that you expect not to collect. Whatever you get for an answer there, that is what your bad debt expense is going to be. Okay, so we have credit sales of 620,000. We estimate that 1.43% of these credit sales will eventually default. Okay, then we get some more information. During the year, one customer does default on $524, meaning one customer is not going to pay. Prior to the write-off and adjusting entries, it shows us Crimson's accounts receivable and allowance for doubtful accounts balances were 304,000 and 134. Okay, this is kind of additional information in this question here at the end. But you're going to see, well, no, not all of it. This 134 is kind of additional information, but our allowance for doubtful accounts rolls over. It is a permanent account. It's always going to be there. Okay, so it already has a credit balance of 134 in it. Okay. Our accounts receivable is currently at 304,000. That's how much people owe us. We had credit sales at 620,000. So first, estimate the bad debt for the experience for the period. I don't know what I was trying to say there. All right. So we're using the percentage of credit sales method here. You're going to take the percentage of credit sales, multiply by the percent. So 1.43% when you poke it out. Moving the decimal places 2 points to the left, use fine. That bad debt expense is going to be $8,866. Okay. So that is the bad debt expense for the period. Second says prepare the journal entry to record the write-off of the defaulted balance. I actually like to move to number 3 first. So if you think about those questions, the next thing I would do is I would record the bad debt expense after I just calculated it. Bad debt expense, record on December 31st, 8,866. Okay, it goes into the allowance for doubtful accounts. Now, 2, when the customer defaults, okay, we've already recorded the expense by estimating it. We do not need to record the expense again. We put it into the allowance for doubtful accounts. So now we take it out of the allowance for doubtful accounts with the debit entry, and we credited accounts receivable, making an asset lower, because now we know that we cannot expect to receive this money from that specific customer. Okay, and this is kind of how our allowance for doubtful accounts would start. We'd have 134 over here. They did their write-off first. Okay, and then they did their estimate here. Oops. But as you can see at the bottom, the 8,476, that's the important number, because that's the amount moving forward for the remainder of the year that they expect that they're not going to collect on their current outstanding balances. Okay. So that is what would be reported, our accounts receivable. 303,476. Okay, so 304 minus the 524 write-off. Okay, we would list that, less the allowance for doubtful accounts. So our net accounts receivable and what we would report on the balance sheet for this one would be $295,000. Okay. Here's just kind of a little trick. Suppose some money comes back or they pay it all. If money comes back after it's already been written off, the first thing we got to do is do a reversal of our write-off entry. So put it back in the receivables, put it back into the allowance for doubtful accounts, and then do a normal collection entry by debiting our cash and crediting our accounts receivable. All right, that's it for this video. That was the simplest method. Okay, so what's important to remember from this is recognizing revenues with the correct amount, recognizing the net amount with the sales discount, 210, net 30, 2%, paid within 10 days, net 30, you might see 315, net 45, 3% discount, we paid within 15 days, if not, the net is doing 45, okay? So you have that, you have your allowances, and then we started estimating bad debt expense using the percentage of sales method, where you take credit sales multiplied by the percent that you estimate you're not going to collect, and that becomes your bad debt expense. Okay, so that's the first part of this chapter. Next part, we're going to talk about the aging method, another way of estimating our bad debt expense, and how to calculate for some notes receivable with an interest component. I'll talk to you again in that video.